So much for tuning into Talking Point. I'm your host, Neeraj Shah. Our guest today is Vinay Jaising of JM Financial. Vinay, great having you. Thanks for taking the time out.
Thank you so much, Neera.
So, Vinay, what's your stance, or how do you look at risk assets from your prism currently, considering all the pulls and pressures, not as much geopolitic as much as central banking and inflation driven?
So, absolutely. I think the risk on trade has been going on for a long period of time. You've seen Nasdaq move up by as much as 30%, Japan move up by as much as 20%, and India, which I think is a risk off mode, has been up only 6 to 7% in the last 12 months. We are looking at FITT data wherein India is actually up 15 to 16%. So, India's fiscal year has started really well. Courtesy, I think, inflation levels globally being a big question mark, and the World Bank, being resilient into trying to get inflation down. Interestingly, every bank is trying to increase their interest rates to get inflation down. US has done it time and again. What that has led to is two-year chart for US is at an all-time high, close to all-time high of 5%, and the 10-year at about 4.1, 4.2%, showing a backwardation or a minus 70, 80 basis points, which for me means, use the word recession, use the word slowdown, but US is having its sets of problems. You've seen labor data also come out, which is unemployment rate has inched up to about 3.8%. So I think US is definitely having a slowdown mode. On the other side, every data point coming in from India, be it the GDP growth, which was north of 7%, or be it the PMI numbers, which are inching up, even for manufacturing at 58, 59. Every other PMI number is at 60 levels. GST numbers are good. So in my eyes, a risk of trade is in the reckoning. You've started seeing that in the last 3 months. Club that up with decoupling for India as well, which is happening. So it's relatively good times for India, and I'm of that boat that India will relatively outperform the rest of the world, including EMs, in the next 6 to 12 months.
Okay. That's music to the ears for the bulls, Vinay. Just one quick follow-up on the global side, and then I'll move on to EMs as well in India and within that. Friday, we saw the first instance of, while the 10-year yields staying where they were, or maybe not really deviating too much, though they've come off from 4.35 odd levels to 4.2, but the 2-year yields came off. Now, the question is if indeed the inflation or the expectations around the Fed action have moved from maybe a 25 bips to a pause, and if they move to a cut sooner than anticipated, could that be positive for equities by and large? I know you said that India will outperform. Could this move actually add some luster to that outperformance?
I think if the valuations were not where they are, it should have done that. But let's take the example of a simple mortgage payment in US. Not too long ago, the US mortgage rate was, let's say, 0 plus 2%. And today it's about 5.3, 5.4 plus 2%. So invariably for $1 million house, you're paying from $20,000 of mortgage up to about $75,000 to $80,000 a year. So your mortgage rates have gone up by about 3 to 4x levels. So even if there was a pause, the pain for the interest rates to come down is a long way ahead. Having said that, remember, even when we look at US, you take out, the AI related stocks, most of the rest of the stocks are not up 30%, they're up 10 to 12%. You're already seeing the banks, there are some rifts being announced, service sectors, at least in IT, you're seeing, people being let go. So you have some sense of problem, and I think it's not how long the interest rates are increased, but how fast the interest rates fall in US, which will decide the global markets. As compared to that, I think emerging market, which is down 5% now, CAGR for the last 3 years. It's underperformed by 5% CAGR, I repeat, for the last 2 years, as against, let's say, India. This is up 15 to 16% in the last 3 years. There could be a valuation call, short-term pump up when interest rates move up. So I think emerging markets, shorter term, medium, long term, Indian markets, these are two markets, I think, which may look good purely based on interest rates.
Okay. Now, Vinay, you've looked at cycles and markets for multiple years now and through various lenses as well. Would love to understand, as things stand within India, with the presumption, rather going ahead that what you said on Indian outperformance turns out to be true. So let's assume that hypothesis turns out to be correct. What within the subsets would find traction? And I start off this question or this I start off this question with a fundamental question of how a large set of investors usually, and maybe for the right reasons, shun uh, PSUs and B2G companies also. And when I look at the evidence of the last 6 months, arguably the best performers, if not all, have been companies which have benefited by either the B2G contracts coming into play, or they are even government companies per se. So, what do you think stands to win over the course of this move where you say India will outperform? And do PSUs stroke B2G companies continue to play the winning hand there?
Very, very interesting question. I'm going to address it, largely broken up into a couple of ways. If I look at the earnings growth of India in the next 2 to 3 years, and I compare it to the last 2 to 3 years, India Inc., last 2 to 3 years was all about the financial sector growing by 40 to 50%. Incrementally, they were about 30 to 35% of the indices. So a lot of weightage for the index growth came from the banking sector. To be particular. Even the first quarter results, which came out of this fiscal year, the banking sector was up north of 50%. And the reason behind this is two: one, very impressive loan book growth, and second, more importantly, the COVID provisions which are being made are being tapered down. Now, this COVID provisions which are being tapered down, if you look at even the banking results on a QOQ basis, not on a year-on-year basis, have started declining. So I think in the longer term, the banking sector will grow in terms of their loan book growth, which is 10 to 15% on the top line, and a similar number for the next 3 years on the bottom line. So these are not going to be gross outperformers to earnings contribution. The earnings contribution largely, in my eyes, would come up from the capex driven sectors. And here's where you spoke about government and PSUs. The Indian government has increased the budget for, be it power, be it defense, be it water, be it road, be it railways, by about 5.5 to 6 times in the last 10 years. In the case of railways, they've increased it by about 7 to 8 times. In the case of water, they've increased it by 8 to 9 times. In the case of defense, they've raised it by about 2.5 times. And they're also making defense a lot more domestic. So a lot of government companies which happen to be in the capex part of the sector are getting order books which are equivalent to 5 to 6 times their current revenues, which means A, visibility is very high. B, now if their balance sheets are very strong, they're also focused a lot on cost. Their bottom line growth is going to be highly operationally levered, and we'll see a lot more growth coming in from these companies, and contribution to the indices will also fall. So I think, it is a nice time to be in the capex run companies. They happen to be government run, a lot of them. Some of them obviously are not, which are the equipment manufacturers. But that's the space I would be super excited on. One more space I would be excited on would be in the Make in India or the China Plus One theme. Think of some beaten down sectors like specialty chemical, wherein India has a prowess for having lower raw material costs, which is, let's say, the bromine chain. And B, where in the future possibilities you could have PLI giving them also some incentives for production. And intuitively, the rest of the world, because some of these products could be hazardous, don't manufacture it. And all of a sudden you've got not just a China producer, but an India producer. Today, this act is not working well because inventory levels in China is very high. That's why a lot of these specialty chemical sectors are down. But these could be good earnings drivers in the future. So our bets are largely on domestic sectors, capex sectors. They happen to be government and PSUs, and we are not shying away from buying them.
Wow. Well, very interesting answer. I'll have follow-ups on two of these points that you mentioned. The first one is, so within the PSU bucket, and I heard you speak about water. I mean, the fanfare is around railways, around defense, maybe not as much around water, or maybe I'm missing that. So my question to you is, from here on, because a lot of these businesses have, or the stock prices have rallied and the businesses have done well too, from here on for the next 2-3 years, where do you see the possibility of the biggest bang for the buck? What subsets within this PSU bucket?
It's not a very easy answer, but I would tend to believe the current winners in the last 3 to 6 months, though I spoke about water was not PSU. Water is, it's a private company, but listed at 10, 11 times forward. You got way above. Having said that, there are a lot of railway companies and defense companies, which, yes, have moved from 15 to 20 time multiples to straight away 25 to 30 time multiples. But if you look at their last quarterly result, you see them doubling their profits, some of them, especially in railways, and you're seeing analysts increase numbers by 30 to 40% in the future. So, yes, they look at 25 to 30 times F25 numbers, but my bet is analysts will keep on increasing numbers. Interestingly, geopolitical risk is here to stay, irrespective of the political condition in the country. Next 12 months, the biggest risk obviously we have is politics. But keeping that aside, you will not see a reduction in the budget in defense. And defense is one area where, though the stocks have done really well, where we would be focusing on, all the PSU companies, in my eyes, look relatively very good in this space. Similarly, as the rail budget has increased, and I said, multifold time, there's a problem of supply of products for these people. Their capacities are enhancing. That's a beautiful problem to be in, and none of them are largely over-levered, which means most of them, are more or less at under one time EV EBITDA, under one time net debt to EBITDA, which makes them also look attractive on an ROCE basis. So I would be betting on railways. I would be betting on capital good sector. These are two spaces where I would bet on in the PSU space, along with defense.
Got it. Thanks for that explanation. Really helps. The other aspect is specialty chemicals. Now, I've heard a bunch of your peers, and both on the buy side and the sell side, now starting to talk about spec chem in the last 1 month. We've seen some bit of an uptick in prices too. I heard you mention about the bromine chain, and arguably slightly beaten down. A bunch of other chains out there beaten down. Save for maybe fluorination, most of the other things have gone through a hibernation stroke correction. Would bromine be the first amongst equals, or is that arguably the only one that you like the most because it will give you the best return potential, or are there others too?
So bromine and fluorine are the two chains our pharma and specialty chemical analysts likes, and for a couple of reasons. One, when you look at bromine, you have fire retardant business coming up. Second, most of these bromine chains are moving into bromine derivatives, and then you can start using them for the pharmaceutical and the agro industry. Incrementally, there are also the stories which move into electrolysis and EV. So there are a couple of companies, I'll name two of them. One is Tatva Chintan and the others Arkin. They're today's stories for bromine and moving into, in the future, especially Tatva Chintan, into straightaway electrolysis and hybrid cars. EV is the future of tomorrow. These are companies which, though small, have such strong manufacturing facilities and cheap raw material costs. They could have a huge edge as far as margins are concerned. Today, when commodity prices are so less, they're still declaring reasonably neutral to positive results on a year-on-year basis. You can imagine when you start seeing the prices of the commodities move up, their bottom lines would be much better. Again, there are many companies in this chain. Bottom up is a bit safer. Again, since I mentioned these two names, let me just focus a minute on Arcane. Here's one company which is net cash with about 5+% of its market cap as cash. It's got a return on capital employed already of 25 to 30%, and it's at low 11 to 12 times multiples 1 year forward. So valuations also your way. Remember, the first question you asked was largely mentored about whether valuations for India have started getting expensive. And here there are some companies which are beaten down at 10 to 12 times multiples with very, very high ROEs. So that's where I would focus on. So bromine and fluorine, but largely bromine.
Got it. My final question, and that's with regards to not necessarily asking you to comment on Kotak as a stock, but some of Kotak, HDFC Bank, and some of the others have kind of, and I'm moving tracks here, but they've kind of not quite lived up in performance terms in the last 6 to 12 to 18 months. I was reading a note this morning which spoke about how in this period, I mean, a Kotak might now be cheaper than ICICI Bank, wherein the ROE is actually improved in that period to nearly 15% as well. So, and there is a large event that has happened with Uday Kotak stepping down too. So, these set of banks, because I heard you say that you started off this answers or this conversation saying that you were constructive or the market has made money in financials and now it's moving on. My question is, for some of these high quality financials which have always been the best return givers in the preceding 15, 20, 25 years and have not done so well in the recent past, is there time likely to come?
I think visually the answer is yes, because if an HDFC bank, which is obviously become a lot more bigger courtesy its merger with HDFC Limited, and Kotak, they both have been derated in the market. Both are at about 2.6 times price to book 1 year forward, as against an average for about 3.5 for HDFC Bank and not for Kotak Bank. So they have certainly become cheaper. HDFC Bank and Kotak have depicted very low, very strong loan book growth, and their bottom line earnings have also been very good. So market seems to not like them largely because you've seen. I'm again going back to one of your questions on PSUs. You've seen companies like Bank of Baroda, SBI, which have taken digitization to its hilt and moving the ICICI way on the operational front. So you've got a problem of plenty in my eyes in the banking sector, all of them very high quality, high ROE. And you've got some MFIs, which are trading at 4.5, 5% ROAs and 1.2 times book. So as far as the financial sector is concerned, we would say the lending space is still attractive to look at. Where we are a lot more negative, the non-lending space. And yes, when you get concerned on the market, the multiple today is at about 20 times 1 year forward, which is in line with the last 5 years. If you start seeing the market move up by another 10%, that's the time wherein as safer heavens, I would look at the top two banks because they are clearly have been underperformers, and I can't point out a single reason as to why they are underperformers because their earnings growth have been very strong. So yes, one should have them in the portfolio. The question is just the sizing.
Yeah. Vinay, fabulous talking to you today. Thank you so much. You gave us insights into a lot of aspects. So thanks for that. And thanks for joining on the show today.
Thank you so much. Cheers.
And viewers, thanks for tuning into this edition of The Talking Point.